So thank you all for still sticking around. I know this is the end of a very long day for all of us. So I'm actually going to be deviating a lot from what everybody else has been doing and present a purely empirical paper. So this is joint work with one of my colleagues at the New York Fed, Or Shahar, as well as Anna Costello from Michigan Ross and Jennifer Lau from Columbia. And before I get started, I do actually have to say the disclaimer because we're using a lot of supervisory data. So these are our views and not the views of the Federal Reserve Bank of New York, the Federal Reserve System, or FINRA. OK, so I should also add the additional disclaimer that this is very preliminary work, so all of your comments are more than welcome. OK, so what are we aiming to do in this project? We are trying to think about how financial institutions take on credit risk in different types of markets. And in particular, if you think about how a financial institution can expose itself to the credit risk of corporate sectors, they have a few alternatives. One is you can go and buy directly the bond of a non-financial firm. You can issue a loan to a non-financial firm, or you can buy a CDS contract written on either the bond of the non-financial firm or the loan of the non-financial firms. Now, in reality, a lot of these institutions are actually going to participate in a lot of different credit risk markets. So if we're trying to think about how financial institutions are taking on this corporate credit risk, we actually want to think jointly about their exposure to corporate credit risk in all of these markets. Now, this fact is going to add complexity to how corporate credit risk is distributed within the within the financial sector. And in particular, we're going to need to know both fundamental positions, so meaning positions in things like bonds and loans, as well as derivative positions. Now, the fact that financial institutions are going to be trading with each other in all of these markets is going to create bank interconnectedness. And that's going to have implications, for example, for systemic risk, as well as how credit is originated and distributed in the economy. So what we're going to do in this project is to conduct an empirical analysis of the flows in the corporate bond, credit default swap, and syndicated loan markets. So I've mentioned this before. Why are we interested in looking at these three markets in particular? These all represent different ways for trading corporate credit risk. So again, by buying a corporate bond, you're directly trading in the credit risk of that corporation. By issuing a syndicated loan, you're again taking on direct exposure to corporate credit risk. Now, in practice, of course, syndicated loans are restricted to very large borrowers. And in particular, the set of companies that borrow using syndicated loans is slightly different than companies that issue bonds. And finally, we're going to look at the CDS market because that market provides a way for participants to take on both long and short positions in corporate credit risk without necessarily having to directly lend to the ultimate borrower. And what we're going to do in this paper is we're actually going to try to link participants across these three different markets, and in an attempt to create a more complete picture of how financial intermediaries assume this corporate credit risk and then distribute it amongst themselves. OK. So I warn you that this is very preliminary, so I'm just going to throw up a slide that will give you an idea of where we're heading with this project. Now, this is not nearly where we are at right now. But again, the primary question is going to be what determines dealers' gross and net exposure to corporate credit risk, and in particular, to what extent derivatives are actually being used to hedge corporate credit risk exposures and not just for speculative purposes. Now, as part of the discussion, we're going to be looking at interdealer networks in over-the-counter markets And in particular, we're going to be looking at questions like what determines the centrality of a financial institution in the OTC network, what determines the position that they have with a particular counterparty, what determines the position that they have in a particular underlying, et cetera, et cetera. And then we're going to be looking at how these networks are actually going to be, how these networks compare across these three different markets. Do they overlap? If you have, for example, if you have a trading relationship in one market, does it make you more likely to have a trading relationship in another corporate credit market, et cetera, et cetera? How stable are these relationships? Can we actually predict when new links are formed? And what are the characteristics that make it more likely for a link between two counterparties to form? And finally, what we are kind of the broad question that we are aiming for is how do these overlapping network structures distribute corporate credit risk of the financial sector? So in particular, what we're trying to think about is whether the fact that you have a choice in how you take, that you as a financial institution have a choice in how you take on corporate credit risk, whether that's actually going to allow the financial sector to absorb risk coming from the non-financial sector better or worse than if you did not have this overlapping network structure. Okay, now what am I going to show you today? Today I'm mostly going to be focusing on some results for the CDS market. So in particular, I'm going to show you some details of how the CDS trading network looks like. Again, what are some of the determinants of the centrality, of the amount of flows that we have between any pair of counterparties that we observe, as well as things like what is the probability that we have a trade, that we can observe a trade between two counterparties in the CDS market, conditional on observing trading in the bond market, or conditional on observing relationships in syndicated loan markets. And one way to think about this beyond just a pure data characterization is that the implications of this analysis can be useful for some of the recent models, network models that people have written down for OTC trades or for search and matching models, as well as for the risk management models for dealers or more broadly for financial institutions. Okay, so let's talk about the data that we're going to be using. So for CDS, we're going to be using data from the DTCC, and in particular, being at the New York Fed, we actually have access to the supervisory data that New York Fed receives from DTCC for the 6 dealers that the New York Fed supervises. Now, the way this data is structured, basically every week we get a snapshot of all of the positions in the CDS market that are still open as of that week. What that means is if, for example, there is a position that was opened and closed between 2 snapshot dates, we're not going to be able to see that trade. But to the extent that that a lot of these positions are in place for more than a week, we're actually going to be able to observe those. So, and then for each outstanding position, we're basically going to be able to see all of the characteristics. So things like what is the actual underlying for that contract. And in particular, we're going to be able to see positions in both single name and indices and actually tranche securities as well. And both for corporate and sovereign credit risk. Again, here I'm just going to be focusing on the corporate side. And then we can see things like the notional amount of the trade, the maturity of the trade, the CDS spread, and the upfront payment at which the CDS contract is traded, as well as the currency and the restructuring clause. So literally, the way one of these records looks like, we know the names of the 2 counterparties. We know which one of them is the buyer. We know which one of them is the seller. All of the characteristics of the contract, which which platform it was settled on, et cetera, et cetera. So this is actually a very, like to the extent, so this includes, for the trades that we see, this includes all the characteristics of the trades, essentially.
You gonna know if they hold a bob?
So we are in the process of matching to that. So because we, again, being at the New York Fed, we actually have the regulatory version of trace, meaning that for institutions that are members of FINRA, we actually see the identities of when they trade in and out of their positions. So we're not at that stage yet, but that is actually where we're going with this.
How often is the other counterparty also one of the 6 dealers?
I will show you that in a little bit. Actually, like in terms of comparing, in terms of trying to figure out how much of the market we are covering with this data, we're going to look at 3 types of numbers. One is going to be the number of contracts that we observe. One is going to be the gross notional amount, and the third one is going to be the net notional amount. So just to make sure that we're all on the same page, let's talk about what all of these numbers mean. Right, so let's talk about how we're going to be comparing our universe to the DTCC universe. So imagine that we observe a transaction between DRA and DRB, where DRA is going to be buying $100 notional of CDS on corporation XYZ from DRB. Now, in terms of these 3 ways of counting contracts, if this is all of the contracts that we see, obviously we're going to just observe 1 contract, so the number of contracts is going to be 1. The gross notional is going to be 100 because this is what's being traded. And the net notional, which is the sum of all the buy positions, is again just for the sum of all the buy positions for institutions that are buying on net is going to be 100 because here we just have 1 position for 1 buy position for DRA, which again is $100. Now, if we see a second transaction where DRB is going to be selling a $50 CDS notional on again, corporation XYZ to DRB, now we're going to have 2 contracts. The gross notional is going to be 150, but the net notional is going to be 50. So these 3 numbers basically each give you a slightly different idea of exactly how much trade is happening and what is the direction of the trade. Okay, so here, so here the first column is going to be the data that we actually see. So this is the DTCC supervisory data. The second column is going to be the DTCC universe. So for the number of contracts, gross notional, net notional, and basically I'm giving you a summary across all the weeks that are in our sample. And so the main point here is going to be that even though we are only observing 6 dealers, I should actually say that for our numbers, we're not actually including the index trades, whereas the TIW include the index trades as well. So basically for a large part of the sample, we're actually covering a large part of the DTCC universe. In terms of the other characteristics of the trades that we observe, a lot of them are going, again, by their nature, are going to be dealer to customer, precisely because we only see these contracts if they're going through these 6 dealers. Also, as people usually find in this market, a huge fraction of the trades is actually in the 5-year maturity bucket. So in our particular sample, it's something like 73% of the sample is a 5-year maturity. Okay. In terms of the explanatory variables, we're going to be looking at. We're basically going to try to run kind of standard explanatory variables. So we're going to look at a measure of size. Here we're going to be using book equity. A measure of leverage, we're going to be using book leverage. Then we're also going to look at enterprise value, which is the sum of the book value of liabilities and market equity, book-to-market ratio, equity return on the financial institution. And then we're also going to look at these integrator variables for whether a given pair of participants in the CDS market have a relationship in one of the other credit markets. So things like whether the seller of the CDS is selling a bond to the buyer of the CDS in the same period, whether we see a syndicated loan from the buyer to the seller in the same period, or whether we see the seller and the CDS buyer being members of the same syndicate in the syndicated loan market. For a subsample, we're also going to be able to control for things like value at risk. Again, this is going to be a subsample of the institutions that we observe. And also for a subsample of the institutions, we're also going to be able to control for the CDS return. Because again, not all of these institutions actually have created CDS. Okay, to give you an idea of what these networks look like, so this is a snapshot of each network for the last week in the sample. So this is the CDS, the bond, and the syndicated loan network, where for these two, the arrow, well, I'm not sure that you can see the arrows, but where the arrows are going from the seller to the seller to the buyer, the lender to the borrower. Now, to give you a better idea of the network structure, here I'm showing you the CDS network again for a particular week, where the warmer colors correspond to nodes that have a higher measure of centrality in the network. So as you can see, there's going to be a core in this network which intermediates a lot of trades, and that core is actually bigger than the 6 supervised dealers. And then there is also a large fringe of institutions that have very low centrality because they only have a few trades observed. Now, if you look at the trace network, so here again, so one of the peculiarities of trace is that you observe the identities of all of the members of FINRA, but you don't observe any of the identities of the clients. And in particular, all of the clients are coded with the same identifier. But to the extent that a lot of the trades are actually going in between, a lot of the trades in the bond market are going in between FINRA members. Again, this is a snapshot of the network. And again, you can see that you're going to have a core of institutions that are central, and then you're going to have a fringe of less connected, less central institutions. Okay, so in terms of the directed graph, so in the CDS dataset, we actually have 936 nodes. So these are both dealers and customers. And the way that we're going to construct an edge of this graph is using a maturity-weighted gross notional amount traded. So in particular, we're going to aggregate across all contracts that node I is going to be buying from node J. And the way that we're going to be doing that across different underlyings is by weighing with the risk-neutral duration of the contract. And after we've done this procedure, for each week, we're essentially going to have an n by n weighted adjacency matrix where an element in this matrix is again the risk neutral duration weighted amount that node I is buying from node J. And since this is a directed network, this matrix A in each period is not going to be symmetric. So I mean, mostly I'm going to be talking about the bi matrix, and of course the transpose of that is going to be the cell matrix. Okay, we're going to be looking at a bunch of different centrality measures. Most of them are going to tell us the exact same story. So we're going to look at things like the in degree, so meaning how much node I is buying, how much node I is buying from all its connections, the out degree, how much node I is selling to all of its connections, eigenvector centrality, which is just the left eigenvector of the adjacency matrix, betweenness, so the amount of network flows that a node is intermediating, and of course, for the CDS matrix, for the CDS network, we can only construct this for the 6 supervised dealers, for obvious reasons. And finally, we're also going to look at closeness, which essentially is the reciprocal of the distance of node I to all of the other nodes. And again, it basically gives you an idea of how far you have to travel from node I to get to any of the other nodes.
I mean, other than the degrees, what can we learn from these other measures? Because we have such an incomplete network, or potentially very incomplete network.
I mean, they still give you an idea of how the nodes that were observed, to what extent the nodes that were observed are connected. So in terms of things like eigencentrality, I should say this is on the x-axis is on log scale. So as we can see, there are differences both between the supervised dealers in blue and the non-supervised entities, both for the buy side and the sell side. Similarly, for in degree, I mean, by construction, the supervised institutions are going to be much more central than any of the other institutions by any of these metrics. But what we want you to see is that even within the non-supervised institutions, there's actually significant variation in how central they are. So this basically gives you an idea of, I mean, you can think of this as telling you how much, what is the dispersion in how much these other institutions trade with these supervised dealers. Betweeness, again, remember that this can only be calculated meaningfully for the 6 supervised dealers. And again, there is still variation between the supervised dealers as well. Betweeness kind of gets at this, like how much trades there is between the dealers to some extent. I'm also going to show you some results on kind of the pairwise relationships. Okay, so I'm just going to say 2 words about these types of tables. So here we're basically doing cross-sectional regressions, and then we're also going to be doing time series regressions of all of these different centrality measures for on characteristics of the firms, including what type of financial institution they are. And one of the things to note, where the excluded category are actually the 6 supervised dealers. Now, not surprisingly, that relative to the 6 supervised dealers, everybody else is less central. The other thing that's kind of interesting is that for For most of these measures, your centrality increases, or actually for all of these measures, your centrality increases the larger you are. And again, that's kind of a standard finding that you get with these types of networks, that the larger an institution you are, the more trades you can basically participate in. Now, if we look at, for example, how centrality measures across different markets correlate. So here, for example, how correlated is your centrality measure in the CDS market with the centrality measure in the bond market? We actually see a lot of positive correlation. So meaning that institutions that tend to be central in the CDS market tend to also be central in the bond market as well. Okay. The other thing that's kind of interesting is that in the time series, for some of these measures, the relationship with size is actually reversed in the sense that you actually get a negative correlation between your size the previous period and how central you are in the network this period. And we haven't really figured out like why that's actually happening. And then at the same time, you also see a negative time series relationship between your centrality in the CDS market today and your centrality in the bond market a week ago. And again, we're not really sure why there is this switch in the sign of the correlation between the time series and the cross-sectional relationships. Okay, we can do the same thing, the same types of regressions in the bond market. And again, well, I guess not surprisingly, you also see a positive correlation between, actually, I don't know why I'm showing this. Okay, so let's talk about pairwise relationships. So here, what we're doing is we're running a logit of the probability of a relationship existing between two institutions in the CDS market on an indicator variable of the seller being larger than the buyer, more levered, having higher book to market, being more valuable in the market, as well as, well, in the second column, as well as indicator variables for relationships in other markets and other controls. And here, the main message is that except for institutions that are members of the same syndicate, it looks like you have a higher probability of having a trading relationship in the CDS market if you have a trading relationship in one of the other corporate credit markets as well. And then this also tells you that sellers tend to be larger than buyers, as well as more levered and have higher book to market as well. So these are marginal effects. So, so moving from a 0 to a 1 is, so moving from a 0 to a 1, for example, increases your, I guess it would help if I had the base level probability here as well. Increases your probability by 30 basis points. In terms of the amount of trade that you do in terms of the amount of trade that you do within a given relationship, so here, and these are very badly normalized now that I look at them, but basically, again, So what's interesting here is that if you have a trading relationship in the bond market, you actually conduct less trade in the CDS market. So what these results are suggesting is that even though having a relationship in one of these other markets increases the probability of us forming a trading relationship in the CDS market, the amount of, the volume of trade that goes through that relationship is actually lower. Now, what we think that means is that basically Right, sorry, what we think that means is that financial institutions have an overall counterparty risk amount that they're willing to take on with a given counterparty, and to some extent they don't care if they take that on through a bond market relationship or through a through being members of the same syndicate in a syndicated loan market. But at the same time, the fact that they know that the fact that they have a relationship in one of these other markets makes them more likely to be willing to trade in the CDS market as well. Yeah, so the flow basically tells you, how much, by how much you're willing to increase your position in a given week, knowing that you traded, for example, in the bond market in the same week. Whereas the positions, I mean, we are controlling for quite a few lags of the position in these regressions, but still, its positions tend to be, again, very persistent variables, precisely of this issue that Valentin and I were talking about before, where trades are not canceled that well. It's very hard to actually get rid of a trade. Now, from a supervisory perspective, you do also care about the position, because in the event of a credit event realizing, it's the position that's going to matter. Okay. So let's talk about how many trading partners you actually take on. So again, by the nature of this data, the supervised institutions, of course, have a lot more trading partners than the non-supervised have. But there is still some variation in terms of how many I guess this is sort of going after the question that Martin was asking. There's some variation in terms of the number of dealers that the non-supervised institutions trade with. And then there is some variation in terms of how many customers the supervised dealers trade with as well. So if we look at things, so here we're just doing a logit of whether you have more or less than the median number of, more or less than the median number of clients, actually. If you are participating as a seller or if you're participating as a buyer. And basically, it looks like, it looks like you are more likely to have a higher number of buyers if you have a lower book to market, and then, or for example, if you have a lower value at risk for the institutions where we see value at risk. Now, if we look at the number of trading partners that these institutions have in bond markets, here, of course, here the distribution looks much more even across the supervised and the unsupervised institutions, because we do not face the same observation censoring. And here, but the story is very similar, where, again, we see we see more counterparties if you have lower book to market. We see more counterparties if you have larger value at risk. Smaller value at risk. And again, here are the numbers here are actually are not the marginal effects. These are actually the point estimates, I think. Okay. Now we can also look at how many trading partners you have in a syndicated loan market as well. Right, and again, we can do the same split between between supervised and unsupervised. And I apologize, in this panel the colors are actually switched. All of these are unsupervised institutions, not supervised institutions. Okay, and again, in terms of just running a simple logit of whether you have fewer or more than the median number of lenders, borrowers, or other lenders in the same syndicate, you see the same story where if you have a lower book to market, you tend to have more borrowers. Similarly, if you are a borrower, you tend to have fewer lenders. Now, and then in terms of the number of other lenders in the syndicate, of course, for things like if you're a larger institution, you don't need to have more. You tend to have fewer partners in your syndicate just because you don't need to rely on other institutions to be able to put up the loan. Okay, so in terms of where we are so far, so it seems that, at least to the extent that we observe these networks, there tend to be systematic differences between high centrality and low centrality dealers, even within the 6 supervised dealers. With the high centrality institutions tending to be larger, more levered, and but at the same time with lower book assets. Now, one of the potential explanations for why we actually see differences in terms of the time series correlations relative to cross-sectional variations is that regulatory changes that cause dealers to increase equity may lead to decreased centralities, and in particular may explain why we're actually finding a negative correlation between centrality and size and the time series. We also see that across all of these markets, we actually have fewer transactions with riskier counterparties. But at the same time, if we have a relationship in another market, even controlling for all of the characteristics of the 2 counterparties, we see a higher probability of relationship in the CDS market, but smaller positions. Now, Svetlana was asking about persistence. I'm not going to show you persistence of centrality measures, but I will show you persistence of relationships. So here, I'm just giving you a histogram of the length of continuous trading relationships in a CDS market, where trading relationship means that for how many consecutive weeks do we observe an open position between 2 counterparties. And the 2 things that I want you to see here is, first, these positions don't look like they're being, these relationships don't look like they're being randomly drawn each period, like some of the search models would suggest. And at the same time, there's actually significant dispersion in terms of how long do you maintain a continuous trading relationship in CDS market, which we think are potentially informative for some of these search models of OTC trades or some of these network formation models. Okay, I'm done.
It'd be nice to control it somewhere for need, right? I mean,
for what?
For the need for, so you might have this happening because the guy only uses a CDS for a short time or something.
Yeah, so, right, so, so what we're in the process of doing now is basically for each pair of institutions, for each underlying, for each date, we're matching the positions in the CDS market with the position in corporate bond, with the position in syndicated loans, with the idea of trying to think about why do you have a CDS position? Like, do you have it just because, you have a corporate bond position whose risk you need to hedge, or are you just like entering into a CDS position because you have a directional bet on where a particular company or where a particular index is going to go?
Because even just with the CDS, it'd be interesting to check whether there's people basically shop around with different guys. I get maybe the data is too short for that. As opposed to whenever they have a CDS, it's always with the same guy. That talk about sort of customer switching cost.
I see. Yeah, well, yes. So that we can check, actually. Yeah, that's right.
So the continuous trading relationship, that means an open position?
Yeah.
So it's like 6 weeks, like the typical length of the longest contracts traded?
No. So most contracts are 5-year contracts.
So how come they expire, or like they close the positions after 6 weeks exactly? I thought you mentioned at the beginning that these are like not somehow cancelled or netted out.
No, so you can cancel the position. It's going to be costly to cancel the position, but you can still cancel it.
But almost everybody does, right? The typical contract is 5 years, but it gets cancelled after 5 weeks.
Right.
Then almost every contract gets cancelled.
It can get canceled or it can get reassigned.
Or reassigned.
Yeah.
Is that the observation? That essentially the contracts circulate every 6 weeks?
I mean, to the extent that, yeah, I mean, that's what this data is suggesting, yes. No, so we have more than 6 weeks in the sample.
No, it could be that a lot of contracts are at the end or something like that.
No.
Yeah.
So that's not what's
Or dramatically.
No.
Fair.
Who knows?
Yeah, no, that's right.
But yeah, but that's, I mean, that's something that we definitely need to investigate more, is exactly what's happening here.